During last week's breakout watchlist video, I took a minute to review the market action of the previous week, and you guys seem to like that. So I'll be starting a series where every Saturday, I take a look at what happened in the market the previous week, along with my takeaways. Because this is the first video in the series, I could use as much feedback as possible. What do you want to see more of? What do you want to see less of? And what are some other areas that I can improve the series? With that said, let's jump into this week's market review using the Performance Insight platform. So taking a look, this is Friday's action. We saw the indexes close slightly red on Friday, weak closing ranges, but Friday's action after what we saw on Wednesday and Thursday was basically exactly what you want to see. Some nice consolidation without a large sell-off. Comparing the moving averages to the current price, we see that the indexes are above a majority of those moving averages, except for the Dow Jones, still under the 8-day EMA and the 21 EMA. We do have power trends in both the QQQ, the NASDAQ, and the S&P 500, where you have price, then the 8-day, the 21, 50, and 200-day in the correct order. It looks like we're getting close to that with the growth ETF IWO, along with ARKK, just a couple of those moving averages in the wrong order to sort out. Scrolling down, let's zoom in here and take a look at market breadth. So this is going to be the percent of stocks above the key moving averages here, the 5, the 20, the 50, and the 200-day. This is all sortable, so we could just double click on the 5-day, see that 63% of the stocks in the S&P 500 index are trading above their 5-day moving average. We also see energy had a nice strong week, getting almost all the stocks above their 5-day. Information technology, materials, industrials, and financials are all outperforming the rest of the S&P 500 on a 5-day basis. And that's what I like about this graph is this S&P 500 is marked black, so you can quickly see what is outperforming and what is underperforming on different over a different time frame. So over 50 days, over 200 days, you can see the groups. Scrolling down here, and this was a big shift in the market. I think that happened on Thursday, but we'll check the trading journal in a second here. We're now getting more stocks making new highs than new lows on all the time frames across both the New York Stock Exchange and the NASDAQ. This is a positive. We want to see market breadth improve and new highs, new lows continue to move in the direction of more stocks making new highs than new lows. Scrolling over to the right here, we have the industry performance chart. This is also sortable. And let's sort this on the 5-day just so we get a picture of this week. And this really tells the story. What was the leading group this week? What had the majority of stocks breaking out? That was the semiconductor group, up 8.5%. Software up there, up 5%, internet, 5%, robotics up 3%, 4%. What this is telling me is a lot of the risk-on groups, the risk-on industries, were the groups that were collecting the money. And what was the weakest group? Gold miners, solars, retail, staples. Some of the slower moving groups outside of solar, First Solar and MAXN both had really rough weeks, which contributed to the TAN ETF being down. But overall, really nice story. We could sort on the 5-day closing range and see a majority of the industries closing in the upper half of the daily range, showing that green and yellow background. Let's see, 15 out of 24, so a majority there. And what were the weakest groups closing in the bottom 25 percentile? That's China, retail, and solar. And that's how the week ended. But how do we get there? And the nice thing about the Performance Insight platform is once you're done capturing all your notes, all your trades, you hit the Capture Day button, and it'll export that into a trading journal where you can see each of the past trading days are captured here. So let's use the Performance Insight platform and just walk through what happened last week. So Monday, I called this episode Tick, Tick, Boom, because on Monday and Tuesday, we got a majority of the stocks just chopping back and forth. Monday was an up day in the market. Tuesday was a down day in the market. And then we had that explosion of market breadth and breakouts on Wednesday, follow through on Thursday, and then sideways action on Friday. So on Monday, we did have a power trend in the QQQ and SPY, but a little bit more red on the rest of the indexes. New highs, new lows, something that I wanted to focus in on here. More stocks were making new lows than new highs, and market breadth was relatively weak on Monday coming into this week. Majority of stocks were under their 20-day, under their 50, and under their 200-day moving average. But the big story on Monday was semiconductor stocks, second leading group outside of Chinese stocks. This made a move that we'll cover using MarketSmith in a second here, but this was the big takeaway. Semiconductors were heating up, a leading group in the market starting to heat up, and overall the market action closing in the upper quartile of all the ETFs there, but not the market breadth and the new highs, new lows that we saw on Friday. Skipping to Tuesday, we can zoom in here a little bit. This was the red day in the market and kind of giving me a risk off signal. QQQ still showing relative strength, being up 0.1%, closing in the 40th percentile of that daily range. But the S&P 500 very weak, down 0.7%, closing right at the low of the day. Dow Jones down 1%, Growth ETF IWO down 1.3%, and RK down 2.5%. At this point, we had price under many of the moving averages. A lot of those slopes were sloping down. Because we've had such a tight price action the last 2 or 3 weeks, we were going to see pretty quick moves up or down with any follow through to the upside or the downside. Eventually, it did come to the upside, which is nice. But if you're only taking notes on Friday, you think, how could anyone have been bearish at any point in this week? And that's what the Performance Insight platform is nice for, because you could take a look and say, hey, Tuesday, market breadth was horrible. More stocks were making new lows than new highs. Every single industry group was red, except for semiconductors, which closed basically flat. Another signal of relative strength and why that is a leading group that we want to be focusing on. But the closing ranges, also many industries closing in the bottom 25th percentile. That's a risk-off indicator. So at the end of Tuesday, I was pulling my exposure back, opening up a short position just to kind of offset some of my longs. Then we get to Wednesday's action. This was the big reversal and then break to the upside. You can see the indexes all closing 85% or higher, up 1% or more, all the ETFs there. We get back the power trend in the S&P 500. Market breadth starts to improve, but we're still seeing relative weakness in market breadth and the new highs, new lows, more stocks making new lows. Once again, going over to industry performance, we see semiconductors, one of those top 5 groups, leading the way, up 2.7% that day, now up 4.5% over a 5-day period. Retail had a nice day, clean energy, transports, but a little sign is gold miners down 0.8%, while many of the growth industries were up. On Thursday, we got that much needed follow through. So we saw, again, all the ETFs closing in the top 20 percentile of their closing ranges. QQQ, huge move here, up 1.9%. SPY up 1%. RK up 1.4%. Many of those slopes that were sloping down on Tuesday are now sloping up. We get that power trend in the S&P 500. Price gets over all the key moving averages for all the ETFs. And then we do see market breadth improve. And finally, new highs are outpacing new lows. Semiconductors, once again, the leading group, up 3.5%. Software, internet also taking over on Thursday. And then we already talked about Friday's action. Nice consolidation there. After a move like we saw the Wednesday and Thursday, it makes sense that we just saw sideways action. We don't want to be chasing the action on Friday after the move's already been made. Now we'll jump to MarketSmith and take a look at the charts. So first we're going to go through each of the ETFs, and then I have some takeaways to cover. So QQQ here has been trading above that 8-day EMA, which has been rising. Very good relative strength compared to the S&P 500, and basically all week continues to rise, except for Friday, sideways action here. So really nice move on above average volume on Thursday when we got that follow through price action, closing right at the high of the day and right around the previous resistance area at 334 here. So if we can consolidate and still hold like 327 area, pull back to that 8-day, allow the 21 EMA to catch up, completely healthy action. The mega cap names have been doing the majority of the work for a while now. So if they rest and allow market breadth to continue to improve, that would be ideal here. Jumping over to SPY, you can see a little bit weaker than QQQ because it's not as tech dominated, and a lot of the moves have been coming in the stocks that have kind of signaled themselves as AI stocks. Google, Microsoft, both have that. But what we see in the S&P 500, this is the action on Tuesday where we closed below the 8-day, below the 21, and market breadth was very poor, new highs, new lows, very poor. So at this point, there's a reason why we want to be a risk off. It doesn't mean that we're super bearish, super bullish. Doesn't mean that we can't change our opinion. We want to be able to change our opinion. But at this point, it's signaling more risk off, especially with the mega cap names leading and market breadth deteriorating. But then the nice thing happened. We got market breadth to improve on Wednesday. S&P 500 broke to the upside, closing at the high of the day. We had follow through on Thursday, then sideways action on Friday. Ideally, we build out here below 420 for a day or two and then really rip to the upside and take out this previous resistance at 418.31. I'm not going to talk about the Dow Jones. I don't tend to use it very much in my trading, but I do use the Growth ETF IWO because it most reflects my type of trading with breakout trading. And if you look at this, you can see just how choppy the price action has been over the last 3 weeks basically. You have the 8, the 21, the 50-day, and the 200-day moving averages all right around the same price. You see every day you either jump above all those or fall below. On Tuesday, we had a rough day, down 1.4%, now trading under all those moving averages. But then we had an outside day to the upside on Wednesday, follow through Thursday. And then this tried to get going on Friday over the previous resistance here at 229.73, couldn't, and then closed slightly down 0.4%. This is still giving me like a reason to be cautious in this market with the mega cap names continuing to lead and act well. I need to see the growth ETF IWO stay over all these key moving averages and use this as a launch pad going forward. Don't need to cover RK, similar to the IWO ETF. But what I do want to cover is SMH. This is the semiconductor ETF. And something that I posted on Twitter going into this week was I see two different patterns here. I see a head and shoulders, left shoulder, head, right shoulder that could resolve to the downside. But then I also see a pattern which I've been trading multiple times this year, and it's actually been my favorite pattern to trade. It's when the stock or ETF breaks under the 50-day moving average pretty sharply, and typically on a leading stock or leading group like semiconductors have been. And then we get a rally up to the 50, failure, putting in a higher low, and then consolidation under all those moving averages. Now, this can still break to the downside or the upside. This was the big question of the market, but we did get a break to the upside on Monday on heavy volume, going through the 8, the 21, the 50-day, closing at the high of the day. Then on Tuesday, when we had the down day in the market, SMH basically flat on the day, made higher highs, higher lows, stayed above all the moving averages. That was a signal to kind of stay risk on or have a reason to be risk on. So we're always weighing different reasons to be bearish or bullish. We covered S&P 500, we covered the new highs, new lows, and the market breadth, all reasons to be bearish. Now, a reason to be bullish on Tuesday was the leading group, semiconductor stocks, which have led both up to the upside and the downside, held strong, closing flat, showing good relative strength. Then on Wednesday, we had that follow through, Thursday follow through into new highs for the year, and then sideways consolidation on very light volume, lighter than average volume. Exactly what you want to see here. Now, for the big takeaway, at least for me this week, was when we get this signal noise, all the reasons to be bearish, we saw IWO weak, more stocks making new lows, market breadth weak, and then the reasons to be bullish, semiconductors holding up, QQQ above all the key moving averages. We're always balancing details to be either bullish or bearish, risk on or risk off. And I put on a trade in SMCI on Tuesday, which broke out of 140. And I also put on a trade in ESAB on Tuesday, which was breaking out over 60. Now, these two trades I should have handled in the reverse order. What I did wrong was with SMCI, which was showing better relative strength. It was already up 4%. I had a 20% position on this. I nailed 50% of that, so 10% into strength for just a 4% move here, while I kept my entire position in ESAB on Tuesday because it wasn't at a large gain, didn't hit my stop loss. So I kept a 20% position on this when I should be doing the reverse, right? I should be, if I'm getting signal noise and I'm not confident long or short, I should be keeping the full position of a stock that is showing the relative strength, is in a leading group, breaking to new highs, really kind of commanding risk in the market, which you could see resolved well to the upside. I should have made so much more money on this. While I'm still in a 20% position in ESAB because it hasn't hit my stop, but didn't make a meaningful move enough to sell into strength on Tuesday when we had the kind of bearish signals. So instead, if we see reasons to be bullish, semiconductors holding up, QQQ holding up relative strength-wise, I'm going to be a little bit more risk off with any positions that don't have any profit like ESAB, and be a little bit more conservative and try to stay in positions with full positions in stocks that are showing relative strength, are giving me a reason to be bullish in the market. So that was the big takeaway for me. I could have made a lot more money this week if I had done that. And that's the nice part about using this trading journal is I have those notes now where I can review Monday, Tuesday, Wednesday, Thursday, Friday, and go through my notes every single day. And next week, I'll be more prepared with one more takeaway to improve my trading. All right, so that was this week's market recap. And because this is the first in the series, again, I could really use your feedback. What did you like about this recap? What did you hate? What should I do more of? What should I do less of? And if you guys enjoyed the Performance Insight platform and want to use it yourself, you can click on the I button up here and you can get a link to that, along with MarketSmith, which is the trading research platform that I use every single day of my trading. I hope you all have a great weekend, and make sure you tune into my channel tomorrow for the breakout watch list. Take care.